Okay, let's dive deep here. We're looking at a really high-stakes corporate transformation story today. Specifically, the financial blueprint for Opendoor's big strategic pivot. Opendoor 2.0, they're calling it.
Right. And this isn't about, fancy product stuff.
No. This is strictly about the financial plumbing. Balance sheet health, capital moves, and that three-part framework the CFO's laid out to actually get profitable.
Yeah, that's the critical lens, I think. And for you listening, our mission is pretty straightforward. We're dissecting how exactly they plan to hit adjusted net income profitability by the end of 2026. That's the target.
Measured on a forward 12-month basis, right?
Exactly. And we've got the Q3 2025 results, plus some pretty detailed info on the capital moves they made to give this whole thing a runway.
I think zeroing in on just the financial foundation makes sense. I mean, execution really starts with having your capital ducks in a row.
Totally agree.
But, okay, before we look ahead to 2.0, we kind of have to understand the wreckage from the old strategy first. What do those Q3 results really tell us?
Well, they tell a story of, let's call it intentional pain. The CFO was pretty clear these results reflect choices made earlier, deliberately prioritizing extreme risk management over just buying more houses.
So a super risk-averse stance, basically hitting the brakes on buying.
Yeah, pretty much. You see it right away in the volume.
Right. They only bought, what was it, 1,169 homes?
Exactly. Which is, drastically lower than what they were doing before.
That low volume feels like the key thing here, doesn't it?
It absolutely is. But what's kind of fascinating is, despite that rock-bottom buying volume, they still pulled in revenue of $915 million.
Oh, wait, $915 million?
Yeah, which actually beat the high end of their own guidance.
How does that happen? Less buying, but more revenue than expected. Seems backwards.
It really highlights the trade-off they were making. The revenue was high because they were selling through their existing stock. Homes bought months ago under the old, less, let's say, rigorous strategy.
Ah, okay. So they were basically just liquidating older, maybe less profitable assets.
That's it. Clearing the decks.
So if I'm following, the lack of new, better inventory meant they hit a revenue number in Q3, but it hammered their margins because they couldn't mix in fresh, higher quality homes.
Precisely. They were stuck selling that legacy stuff, and you see the hit immediately in profitability. GAAP gross profit down significantly. $66 million compared to $105 million the year before.
Ouch.
Yeah. And a contribution profit really took a dive, just $20 million. That translates to a contribution margin of only 2.2%.
Wow, 2.2%, that's thin, down from 3.8% the year before.
Yep. That's the cost of unwinding, maybe some less than ideal decisions from the past.
Okay, that margin pressure is definitely concerning. But you mentioned the silver lining, something on the cost side.
Yes, exactly. That's sort of the foundation for the future scaling part.
Aye.
Even while leadership was changing over, they'd already started slashing costs pretty significantly.
Okay.
Adjusted operating expenses came way down, $53 million. That's a huge 41% drop from $90 million in Q3 of 24.
41%. That's a fundamental structural change.
It really is.
It suggests that when they do start buying more again, they're starting from a much leaner fixed cost base.
Yeah.
That's going to be critical for hitting those leverage goals later.
Absolutely critical. Now, the bottom line was still red, a net loss of $90 million, reflecting that margin pain.
Right.
But the adjusted net loss did get a bit better, $61 million versus $70 million the year before.
Yeah.
So Q3 was kind of a painful but maybe necessary clearing out of the old era, setting the stage.
Okay, stage set. Let's talk about that stage. This Opendoor 2.0 pivot needs a serious financial cushion, right?
Yeah.
What's the balance sheet look like now, and what were those big capital moves?
The balance sheet looks pretty robust, actually. They finished the quarter with $962 million in unrestricted cash.
Almost $1 billion in cash.
Plus, they've got $1.1 billion in net inventory, which is those 3,139 homes, mostly the legacy stuff they're still working through.
Got it.
And crucially, total committed borrowing capacity sits at $1.8 billion.
Okay, so $1 billion in cash, nearly $2 billion they could borrow. Sounds strong. But the CFO mentioned some kind of immediate threat. Something about their convertible debt.
Yeah, they did. This gets a little technical, but it's super important. Their stock price shot up really fast in Q3.
Which sounds like a good thing.
Usually, yeah. But it actually created this weird ticking clock. It could have triggered a condition forcing them to repay their 2030 convertible notes early, in cash.
Yeah.
In Q4 2025.
Wow, so their stock doing well nearly caused a massive cash crunch. That is ironic.
Very. So to deal with that immediate pressure, give themselves breathing room, time to actually do 2.0, they got proactive with their at-the-market equity program, their ATM.
Right, the ATM raise, that was pretty big, wasn't it?
It was substantial. They sold about 21.6 million shares at just over $9 a share, $9.26. Raised almost $200 million.
Okay, so nearly $200 million in fresh cash. That shores up liquidity and pushes back that debt repayment deadline.
Exactly. That ATM was step one. Step two was then refinancing a big chunk of those same notes, the 2030 converts, which had a hefty 7% annual interest rate. They swapped a lot of that debt for equity.
Oh.
So you combine the cash from the ATM with that refinancing, and boom, they cut their cash interest costs way down and got a lot more financial flexibility for the next few years. Basically turned expensive, risky debt into a longer runway.
That makes sense. Tactical, necessary moves. But the third one, that shareholder dividend warrant, that felt different. More about aligning interests.
It's a really interesting move, yeah. Kind of like a loyalty bonus for sticking with them. For every 30 shares you held by a certain date, you got 3 series of warrants, K, A, and Z.
And these warrants let you buy stock later, but only if the price goes up significantly, like $9, $13, and $17 exercise prices.
Exactly. So they only pay off for shareholders if the company actually executes and the stock hits those higher targets.
So it's like they're saying, we're doing the hard work, stick with us, and if we succeed, you get this extra upside.
Pretty much. It signals commitment, right? We're in this together for the long haul to 2026. It's not dilutive right now, but it's potential future value tied directly to their success.
Okay, foundation shored up, runway extended. Let's get to the map. The main goal, adjusted net income profitability by end of 2026. The CFO laid out 3 pillars. Pillar 1, scale high-quality acquisitions.
Right. This is job number 1 for the new model. Why? Because volume drives revenue, obviously.
Right.
But it also lets them leverage that leaner cost base we talked about. Plus, it creates this flywheel effect in local markets, right? More good houses attract more buyers, which makes more sellers want to use them. Market concentration.
Okay, so not just any volume, but high-quality volume. How do they ramp up buying, again, maybe even making more competitive offers without just buying risky stuff?
Good question. They're actually planning to reduce their average spread, meaning make slightly tighter offers overall, but pairing that with much more operational rigor.
How?
Using AI for better scoping up front, standardizing pre-offer inspections, basically getting smarter about which houses fit their ideal profile. Likely to sell fast, need minimal work. They want to be aggressive on the right homes.
Okay, so being smarter buyers lets them offer less spread on average. It sounds like they're saying, we'll make a bit less per house if it means the house sells way faster and costs less to hold.
You absolutely hit the nail on the head.
Which leads perfectly into objective 2, improve unit economics and resale velocity.
Exactly. That's the core of this whole turns, not spread philosophy they keep talking about. For iBuyers, speed is king. Velocity.
Why is velocity so critical?
Because it drastically cuts holding costs. Taxes, insurance, utilities, cost of capital tied up in the house. Plus, it lowers your risk exposure if the market suddenly dips. And if you can turn homes faster, you free up capital quicker to buy the next home. That allows you to offer a lower spread in the first place, which gets you more volume.
It's a positive feedback loop. Lower spread, more acquisitions, better velocity justifies lower spread. That's the magic formula. They could pull it off.
That's the potential, yeah. The strategy here involves what they call a tailored spread framework, pricing really sharp for those high-velocity homes while staying disciplined on houses that look like they might sit or need a ton of work.
So the inventory mix should shift towards homes needing fewer repairs, easier to list quickly.
That's the idea. Shorten that time from buying it to listing it, and they gave us a specific metric to watch here.
Oh, yeah.
Yeah, in their quarterly 10Q filings, they're reporting the percentage of their homes that have been on the market for more than 120 days. That number needs to drop a lot.
Okay, trackable accountability. Good. Now, objective 3 feels like the trickiest balancing act. Build operating leverage. They need to scale transactions faster than costs, but they also need to invest heavily in tech and AI. How do you cut costs and invest aggressively at the same time?
Yeah, that's the inherent tension. And the CFO acknowledged it. They're finding the cuts by, getting rid of consultants, redundant software tools, trimming marketing waste, the usual suspects.
Okay.
But the key is they're supposedly taking those savings and immediately plowing them back into hiring engineers and building out their AI capabilities. The end goal is a fundamental shift in their cost structure.
Explain that shift. What does shifting towards variable components mean for, someone listening?
It means making more of their costs flexible so they scale up and down with transaction volume. Think fewer fixed salaries, maybe more performance-based compensation, or tools that are priced per transaction.
Ah, so if the housing market tanks, their costs automatically drop too, protecting margins. Unlike before, where maybe costs stayed high even if volume fell.
Exactly. The goal is that each extra home they buy and sell adds profit, making the whole operation less sensitive to market swings, more resilient.
That structural change would be huge if they can achieve it. How can we track that?
Again, they gave specific metrics, also in the 10Q. First, watch their fixed operating expenses. That number should stay flat or even drift down a bit, even as they buy way more homes.
Okay, fixed costs flat or down?
Second, look at their trailing 12-month operations expense as a percentage of their trailing 12-month revenue. That ratio needs to hold steady or, ideally, decrease over time. If it shrinks, that's operating leverage in action.
Wow, okay. That's remarkably transparent. They're basically giving us the dashboard to watch their execution.
Pretty much. And for Objective 1, the acquisitions, they went even further, right? They set up that public website.
Yeah, accountable.opendoor.com. You can literally go there weekly and see if they're hitting their acquisition goals on path to 2026. They're really building in the open, as they put it.
It's bold. Puts pressure on.
Definitely. Okay, let's pivot quickly to the near term. Q4 2025. The CFO was careful to call these guideposts, not formal guidance, because things are obviously still in flux.
Right. Understandable during a big transition. The immediate outlook kind of shows the lag effect, the pain from clearing out the old Q3 inventory before the new strategy fully kicks in.
So first guidepost, acquisition rescaling. Are they actually starting to buy again?
Yes. They're committed to ramping up aggressively. They expect Q4 acquisitions to jump by at least 35% compared to that low Q3 number.
Okay, 35% increase in buying. That suggests the new pricing strategy is starting to work, getting them volume again.
Seems like it. But the revenue number for Q4 is going to look pretty rough.
Right, because they basically stopped buying months ago, so there's not much new stuff ready to sell yet.
Exactly that lag effect. They expect Q4 revenue to decrease by about 35% quarter over quarter. They sold off the old stuff in Q3, and the pipeline of new, ready-to-sell homes just isn't full yet.
Makes sense, unfortunately. What about margins? We saw contribution margin tank in Q3 as they cleared the bad inventory.
The CFO said they believe contribution margin probably bottomed out in October. As they start selling more of the newly acquired, hopefully higher quality, faster turning homes, margins should start improving through the end of the year.
Should improve, but starting from that low Q3 base.
Right. So even with improvement, the overall Q4 contribution margin will likely still end up below Q3's number just because they're climbing out of such a deep hole. The upward trend is starting, but it takes time.
Got it. But the cost discipline Objective 3 seems to be holding strong already.
Yeah, that looks impressive. They actually gave a forward 12-month outlook for adjusted operating expenses. For the year ending June 30th, 2026, they're targeting $255 to $265 million.
And how does that compare?
That's a big drop, about $62 million, or 20% lower year over year. And that's while they're supposedly ramping up investment in AI and engineering, suggests they really did find significant ways to cut.
Okay, so lower revenue near term. Margins slowly recovering, but costs staying down. What does that mean for the bottom line in Q4, adjusted EBITDA loss?
Given that revenue drop and the margin pressure, they're expecting a Q4 adjusted EBITDA loss somewhere in the high $40 million to mid $50 million range. It's the cost of making the pivot right now.
Okay, so wrapping this all up, the financial blueprint seems, well, razor sharp on paper. Drive quality volume, turn homes way faster using tech, slash fixed costs by making them variable. And critically, it's all backed by a balance sheet they proactively fortified.
Yeah, and I think the key thing for you, the listener, is just how transparent they're being. Those three big accountability areas, the public acquisition dashboard, that days on market over 120 a metric, and the operating leverage ratios in the 10Q.
Right.
They're giving you tangible ways to track if Opendoor 2.0 is actually working. It's not about blind faith. They're saying, here's how to watch us execute.
And thinking about that execution, particularly that ambitious goal of shifting costs from fixed to variable, it does make you wonder, if they really succeed in making their cost structure super flexible, perfectly flexible with volume, what new or different kinds of market risks might they be more, or maybe even less, vulnerable to down the road? Something to mull over.
A really interesting question for the future, depending on how this plays out.